This chart shows the recent VN index trajectory. We've just dropped below the critical short-term support line at 1751. When a support level breaks, panic leads to emotional trading. Without a systematic approach, this volatility results in rapid capital destruction. We organize the entire portfolio into 4 absolute categories: buy, sell, hold, and wait. Placing every ticker into one of these columns transforms a chaotic market situation into a mechanical execution plan. Before sorting a single stock, the first requirement is to halt all new margin buying. Current market conditions dictate a 100% cash operational stance. This ensures your remaining assets are protected from the risks of leveraged liquidation. We begin with the sell category. Cross-reference your holdings against your original strategy to identify stocks that have violated their safety parameters, such as BSR, CII, or EVF. This table shows the execution phase. When a position hits its cut-loss mark, like BSR at minus 2.02%, the sell order is confirmed, and that capital is converted back into liquid cash. For every stock sold, record its specific new round wait for breakout price. This establishes a clear price threshold that must be reclaimed before any re-entry is considered. Executing these sells immediately is a tactical maneuver designed to preserve your capital for higher probability opportunities. The hold category is reserved for your surviving portfolio assets, like ACB, BAF, or BID. Look at this trading interface for ACB. Holding a position requires an active defense. You must program a hard stop-loss order in your application. For ACB, that exact price is $21,850. Then we have the wait category, which applies to liquid stocks like VIC, VIX, and FPT that are not currently safe to buy. A common mistake is assuming a drop in price is a signal to buy. In a volatile market, a lower price does not automatically represent a safe entry point. This chart tracks the top 10 liquid stocks. Notice the data for FPT. We define a VERT, or breakout target price, in this case 76,700, that the stock must cross before we consider a buy. Combining hard stop losses with these breakout targets shifts your decision-making from subjective guesswork to reacting to specific price triggers. The final category is buy, but this is limited to rare opportunities like HDB or VHM that meet strict criteria. We apply the Noi-Combe-Take-Sun strategy here. These acquisitions are strictly reserved for a 5 to 20-year investment horizon. Because these are long-term plays, they must be funded entirely with cash. Margin is prohibited. This execution screen for VHM shows the process. Even with a long-term outlook, you must input a mandatory stop-loss at 148,500 the moment the buy order is placed. At this stage, every holding in your portfolio should have a defined action assigned to it. These cash-secured, long-term positions are insulated from the immediate risks of margin calls and short-term market swings. Now, review the updated structure of your portfolio. This master spreadsheet shows the final transformation. Losers are liquidated, holds are secured by programmed stops, and your re-entry targets are clearly defined. By assigning every ticker to one of these 4 columns, you have converted a chaotic list of stocks into a structured, data-driven dashboard. To develop a personalized financial strategy based on these data-driven principles, contact the Areca NG hotline at 0914-326-556 or open a VietCap account today.